Hi everyone, this is the second of two screencasts on the area of Schedule E termination payments and share schemes. And this screencast is based on BPP FA 2012 text, so I'll refer you to that text from time to time. Hopefully you've had a chance to look at the first screencast on the area of termination payments. Okay, so in terms of this particular area, really what we're looking at is an individual who has been provided with shares, or perhaps who has purchased shares at a discounted price via their employer, shares in the employer's company. And really the first thing I want to sort of remind you of is earlier on the text we covered this area of unapproved schemes. So we covered the way in which unapproved schemes are taxed. I sort of draw your attention to the difference in the tax treatment of unapproved schemes and also approved schemes, which we'll come on to a little bit later. Okay. Now, before we move on to the sort of the nuts and bolts and the calculations, I think we've got to have an understanding of really why employers do this. In other words, why they provide shares to the employees either free or discounted, and indeed why they would provide share options to employees. And really there's a number of reasons. And the first one, perhaps the most obvious one, is to incentivize the employee. In other words, to sort of link the employee's performance into the performance of the share. If you think about it, if we contract with an employee, we take on an employee, and we give the employee an option to purchase shares at a future date, in other words, an exercisable date, then in fact what we're hoping is that between the earlier date and the date of exercise, that the employee will try to impact upon the performance of the company and will still be employed by the company at the exercisable date. And that may well be, as I said, 3, 4, 5 years or whatever. Okay, so certainly incentivizing and rewarding the employee is key, but also retaining the employee for a period of time. Particularly if the employer feels that that employee is very, very valuable. Okay, so in terms of the process, again, it's good to be clear on the terminology here and also really the tax impact at each of these stages. So we have a situation where someone is employed, they work for a year or two, and the employer grants perhaps an option to the employee to purchase shares at a fixed price at a fixed date in the future. Okay, so really at that stage, in other words, at that first stage, nothing really is happening. There are no tax implications, and really all we have is the employer offering the option or perhaps the chance to the employee to purchase shares down the line. Okay, now where the tax impact comes in is if the employee takes up the option. In other words, if the employee exercises the option, i.e. The employee pays the price as denoted at the grant stage at the outset for the shares. And the advantage to the employee really is that at the grant stage, what the employer is doing in advance, perhaps on a sort of a clairvoyant basis, is that the employer is predicting a price. In other words, he's providing the employee with a price for the share well in advance of the exercise date. And the upside for the employee really is that the shares, all being well, will rise in value. So in effect, the employer is agreeing to a cost price or a purchase price well in advance of a future increased market value. And really for an unapproved scheme, certainly, the taxes due at the point of exercise are really the difference between the MV at exercise, in other words, the increased price, and also the cost price or the exercise price, which was agreed at the outset. So really what we're required to do for income tax purposes is to take that difference into the income tax computation. And indeed, in practical terms, for the employee, what you'll get is a situation where the employee will exercise the share option, pay for the shares, and then receive, in effect, a set of share certificates. And the difference between those two values, MV and EP, as it were, will be the value that we place into the income tax computation. And the problem that that gives the employee, if you think about it, is that he's got paper. In other words, he's got a share certificate. He's had to pay out for the shares. And in addition to that, he now has to pay the tax within 30 days. And if you think about it, perhaps a lot of employees who are in the position to receive share options from their employers will be being taxed at 41%. So it's quite a large chunk to be paid within 30 days, and there is no cash, as it were, unless the shares are sold. So it may well be perhaps that the individual has to perhaps borrow either from a bank or maybe even from an employer, leading to perhaps a preferential loan BIK. So the second stage is the exercise. Now, the third stage, and it could happen at the same time as the exercise, but it may not, is this issue of the employee deciding to sell the shares. Now, what we know at this stage about capital gains tax is not too much, but essentially capital gains tax works around a three-liner. In other words, if we sell an asset that's chargeable to CGT, we have some form of proceeds, some sort of form of sales value. If we take from that the MV at exercise, the difference in effect is the gain that we're making on the sale of the share. Okay, so I'll come on to that again in a moment. Just draw your attention to the left-hand side of the screen here. Just a small little area that we'll be coming on to again later on in the text in terms of residency. But if we have a situation where an individual for part of the exercise period, in other words, from the date of the grant to the first exercisable date is known as the vesting period. So if we have an individual who is non-resident and in effect resident in another DTA country, a double taxation agreement country, then what the tax legislation prescribes is that the element of the gain that relates to non-residency can be stripped out. In other words, they would not be liable to Irish income tax on that value. And you'll remember that we looked at an example the other day where I think the individual was resident for 19 out of 48 months. So we had a vesting period, in other words, a date from grant to first exercisable date of 48 months, and the individual was resident for 19. So we had a fraction to strip out the value that was relevant to the individual in terms of taxation or income taxation. Okay, so really three main areas: grant, exercise, and sale, as it were. So you need to be familiar with what those mean. Okay, in terms of the nuts and bolts calculation, as I've said, for income tax purposes, we're looking at the difference between the market value at exercise and the exercise price. The exercise price will be agreed at the outset, in other words, at the grant of the option, and the market value will be given in the question. So we're just looking to strip out of the question the information that we require and take the difference into the income tax computation. As I've said, for capital gains tax purposes, really the gain is just the proceeds less the MV at exercise. So as you'll see, really these two values are the same. Yeah, and it's careful. We need to be careful to realize that what we shouldn't do is double up. In other words, what we can't do is charge the individual capital gains tax and income tax on the same amount. So just be careful about these numbers, work the questions, and I think it'll become more familiar to you. Okay, so that's broadly about unapproved schemes. What about approved schemes? In other words, the schemes that are specifically approved and really have tax breaks for the individual. Well, there's a couple that we need to be aware of, and this is really the first one. Apologies if you can't read the bottom of the slide there, but it's simply the APSS, so the Approved Profit Sharing Scheme. And each of the schemes that we're going to look at have their own little sort of nuances and their own little rules. So there's a certain amount of rote learning that's required here. But do bear in mind that these are approved schemes, yeah, rather than unapproved schemes that we've just been through. So in terms of the detail here, let's have a look at the APSS. It's actually fairly straightforward, and it enables an employer to, in effect, provide funds to a trust to enable employees to buy shares. So let's be careful that we understand what the what's going on here, what the transactions are. First of all, we have an employer. He has a set of employees, or she has a set of employees, and that employer is providing up to 12,700 euros per individual into a trust. So a trust, what is a trust? Well, really a trust is just a pot. It's just a mechanism for holding value or holding shares or holding cash on behalf of a set of beneficiaries. So what we're looking to do is really to say that the employer pays funds up to 12,700 euros into a trust on behalf of individual employees, and the trust uses these funds to buy and hold shares on behalf of the individual employees. Okay, now there are some other rules coming on in the next slide, but before I go on to them, let's be clear here that the value of the funds paid on behalf of employees into the trust is wholly deductible for the employer. Now, what do I mean by that? Well, what I mean is this, is that if you think about it, let's say that we have a limited company employer. If they're paying out 12,700 euros in a given year for an individual, then they can deduct that amount from their sales, from their revenue. In effect, it is a wholly allowable expense. So that's quite handy. Not only are we giving value to the individual employee, but we're also having a tax deduction for the employer. Okay. Now, in terms of the sort of nuts and bolts for the employee, we've looked at the employer and the tax implications there, which is a 100% deduction. Really, there's no tax for the employee at all. Remember, we said that this is an approved scheme. So there's no tax for the employee at all as long as the shares are held for 3 years. Now, if the shares are disposed of within that 3-year period, then there will be tax payable. So with APSS, let's remember the number 3. Yeah, let's remember the number 3. Hold for 3 years if you want to avail of the sort of approved tax breaks, as it were. Okay, any disposal within that period will crystallize tax, and really that's the sort of thing that I could see John Morrison, your tax examiner, looking at. In other words, rather than simply saying, list the rules in relation to APSS, he may well do something slightly quirky. In other words, put an employee in a position where, yes, they've availed of the scheme, but they've disposed of the shares within the 3-year period. Okay, so when you're studying tax, always look for the exception or the exception to the exception, or someone perhaps breaking a rule and the implications of doing that. Okay, so in terms of the disposal value within 3 years, it's going to be taxed under Schedule E, in other words, under Schedule E income. Rather than CGT. Just be careful on that one. And in terms of the value that's brought into the income tax computation, it's really the lower of these two. In other words, the lower of the proceeds received for the shares or the market value when the shares were acquired. Okay, obviously the lower the better, the lower the tax. Okay, so next point in this area of shares is something that we call share clog abatement. Slightly unusual terminology, but it's fairly straightforward. And all we're looking to do here is to say that an individual employee is being provided with shares, in other words, given free shares or perhaps discounted shares, and there is some sort of restriction on that individual disposing of the shares. In other words, the employer lays down a restriction and says, well, here's some free shares, thank you very much for your efforts, but you can't sell those shares or dispose of those shares for a minimum of 3 years. And what the revenue do is they help the individual out, and they say, well, it's slightly unfair. What we'll do is we'll reduce the value of the taxable amount or the BIK value based on the number of years. And it's really not too difficult to remember, because really what we're saying is that the value of the reduction goes up by 10% in each year up to 5 years, and then over 5 years is 60%, and that's the top end. Okay, so do have a look at the example on page 43 in the BPP FA 2012 text to clarify that for yourselves. Okay, next point. Shares at undervalue. Excuse me. Really, what we're talking about here is just the provision of shares in some way at undervalue. What does that mean? Well, at less than the value that they should be provided at, in other words, at less than MV. And again, all that we're looking at here is just some form of Schedule E income based on the market value at the date that they are provided, or the date that they are purchased, less any cost paid. So fairly straightforward. Okay. Bear in mind that for the individual, the tax or income tax will be payable within 30 days to the revenue at a rate of 41%, unless the individual can prove to the revenue that a lower marginal rate is relevant. Okay. Now, next area of approved schemes is this area of SAYE, Save As You Earn. So do you remember we talked about the APSS? Well, here's another one to run alongside it. And this one is, again, it's reasonably straightforward. All we're talking about here is just this idea of the individual employee really saving as they go through their payslip on a net basis, and saving into what we would call a qualifying savings contract. So I've tried to break this down on the slide here in relation to what's actually happening. And essentially what's happening, if you look on the left-hand side, I'll come back to the top in a second, is that we have an employee that is saving up to £500 per month from net pay, not from gross pay, from net pay. So it's not tax deductible from the employee. A little bit like an amount of money being taken by the employer from net pay and put into, in effect, a bank account or a deposit account. And that is a deposit account, just like any other deposit account, on which the individual employee will earn interest. Now, that interest is tax-free over time, subject to certain conditions. But essentially, all we're saying is that the employee receives their pay, they have tax and PRSI deducted, etc. And from that net pay, they've decided to join an SAYE scheme that's been provided by the employer, and they can join it on either a 3 or a 5-year basis, so they would be required to fund the scheme over those periods. The monies are paid on a monthly basis by the employer into a qualifying savings contract, in effect, just a little bank account that earns interest. And in effect, from the point at which the savings contract is up, the time period is up, then in effect the grant of the option is given to the employee to buy shares. So there's the option to buy shares with that pot of money that's in the savings contract, or that's in the deposit account. So really, at the end of the period, the individual employee has several choices. He doesn't have to take up the option. It is an option. Okay, he can do a number of things, in fact, 3 main things. So the first thing is to actually take up the option. In other words, to take the money out of the account and to buy the shares covered by the option. Now, bear in mind what I said is that there will be some sort of deposit interest or bank interest that has been earned, and that can also be used along with the actual capital to buy the option. And that amount of interest is completely tax-free. So in other words, looking at number 2, the employee could decide, well, do you know what? I don't want to take up the option. I just want to take the money, and I want to take the deposit or bank interest as well. And that amount, and all of the amount, capital plus interest, can be taken tax-free. And the last possibility is simply to continue to invest in the scheme. Okay, so in terms of a recap here on share schemes, I think things to watch out for are really, in the first instance, the terminology. In other words, what does MV at exercise mean? What does an exercise price mean? We need to be familiar with the numbers, and we need to be familiar with the tax implications at each of those 3 stages. If you remember, we had some sort of perhaps grant of an option. Let's say we're looking at an unapproved option. Then we have some sort of exercise on which income tax can be due at that stage. And then we have some sort of sale, and we're talking about CGT. Then we moved into 1 or 2 other areas relating to approved schemes. We talked about the APSS. We also talked about the SAYE. So try and be familiar with how those schemes work. Have a look at the slides, and hopefully they'll help you. Okay. Thanks very much for listening to this short screencast. I'll be uploading some more in the next while, and if you do have any queries, please feel free to come back to me and email me on the email address shown below.